When a war breaks out, most investors panic. The smart money does the opposite, and when that war ends, or looks like it is about to end, most investors celebrate. The smart money rotates. Here is the play that almost nobody talks about. Defense stocks spike hard when conflict escalates. Lockheed Martin, RTX, Northrop Grumman. The Global X Defense Tech ETF returned 59% annualized since its 2023 launch. That is an extraordinary run. But the Motley Fool put it plainly. The worst time to buy defense stocks is when conflicts are in the news and the shares are spiking. New orders take quarters, sometimes years, to show up in earnings. The pop fades. And when peace signals appear, a ceasefire, a negotiation, a drawdown, those war stocks drop fast. What goes up on fear comes down on relief. This video is about what you buy instead, and when you buy it. The pattern, 100 years of data. History is consistent. The Gulf War, the S&P 500 dropped 10% when Iraq invaded Kuwait, then rallied 20% over the following year as conflict resolved. The Iraq War in 2003, markets fell before the invasion, then surged 30% from the March 2003 low by year end. Post 9/11, markets dropped sharply, then gained 15% over the next year. Sectors that are crushed during conflict: consumer discretionary, real estate, financials, travel, infrastructure, snap back. And a second wave kicks in: reconstruction. The World Bank estimates post-war reconstruction can cost up to twice a country's pre-war GDP. That money flows somewhere. Here's where it goes. Subscribe. New finance and investing breakdowns every week. The bond play at number 5 is the one most people miss entirely. The 5 post-war rotation plays. Play 1, XLY VCR, Consumer Discretionary ETF. During conflict, consumers pull back on spending. Airlines, hotels, retail, restaurants, entertainment all get punished. When peace signals arrive, that spending comes back fast, sometimes before the ink on the ceasefire is dry. Post-World War II saw the roaring 50s consumer boom. Post-Gulf War saw a sharp consumer rebound within 12 months. XLY, SPDR, Consumer Discretionary, and VCR, Vanguard Consumer Discretionary, give you the full sector without single stock risk. This is historically the fastest recovering rotation trade after conflict resolution. Risk. Consumer recovery depends on the macro environment. If war ends into a recession or high inflation, the rebound is slower. Post-Vietnam era stagflation is the cautionary counterexample. Play 2. CAT, PKB, URI, Infrastructure and Construction. Post-war reconstruction is one of the most reliable investment themes in history. The Marshall Plan was $130 billion in 2010 dollars. Ukraine's infrastructure damage is estimated at $500 billion plus. Every major post-war period, Europe after World War II, Iraq after 2003, the Gulf states, triggered massive government-funded rebuild cycles in roads, bridges, energy grids, and housing. Caterpillar, CAT, is the global benchmark for heavy construction equipment. The Invesco Dynamic Building and Construction ETF, PKB, covers the full U.S. construction sector. United Rentals, URI, is the world's largest equipment rental company. Every rebuild cycle drives demand for exactly what it rents. Risk. Construction plays require a confirmed end to conflict and a funded reconstruction commitment. Geopolitical delays, see Afghanistan, can stall the rebuild cycle for years. Play 3. VNQ, IYR, Real Estate, REITs. War drives real estate down in 2 ways: rising interest rates from wartime government borrowing and capital fleeing to safe havens. When peace arrives and rates stabilize, REITs rebound sharply. In conflict zones specifically, residential real estate often recovers faster than any other asset class once security returns. People need housing before they need anything else. For investors in the US and Canada, VNQ, Vanguard Real Estate ETF, and IYR, iShares US Real Estate ETF, capture the domestic REIT recovery. They trade at a discount during high-rate war environments and re-rate quickly when the macro picture clears. Risk. REITs are interest rate sensitive. If post-war central banks keep rates elevated to fight wartime inflation, the REIT rebound is delayed. Timing matters more here than with the other plays. Play 4. XLF KBE. Financials and banks. Banks profit from post-war reconstruction in two ways: reconstruction lending and a steepening yield curve as the economy normalizes. After World War II, European and American banks financed decades of rebuilding. JP Morgan and BlackRock jointly raised nearly $500 million in committed capital for Ukraine reconstruction financing in anticipation of peace. XLF, SPDR, Financial Select Sector, ETF, captures broad U.S. financials. KBE, SPDRS, and P-Bank, ETF, focuses specifically on banks and is more leveraged to the lending cycle. Risk. Banks carry credit risk in fragile post-war economies. If reconstruction defaults, the lending book gets hit. Favor diversified financial ETFs over single-name bank bets in early post-war environments. Play 5. TLT, BND. Long-duration treasuries, total bond. This is the one most people miss. During war, governments borrow massively, driving yields up and bond prices down. TLT, the iShares 20-plus year Treasury bond ETF, gets crushed. When peace arrives, government borrowing normalizes, inflation expectations fall, and central banks begin cutting. Bond prices rise as yields fall. Buying TLT, when war-era yields are elevated and peace signals appear, is one of the highest conviction post-war trades in the historical record. Post-Gulf War, bonds rallied hard as the Fed pivoted. Post-Iraq, same pattern. BND, Vanguard, Total Bond Market, ETF, is the lower volatility version for more conservative portfolios. Risk. Bonds only outperform in post-war environments if inflation is contained. If wartime spending has baked in persistent inflation, as in the 1970s post-Vietnam period, the bond rally does not materialize. Watch inflation data before sizing this position. How to time the rotation. You are not trying to call the exact day the war ends. You are watching for the signals. Formal ceasefire talks, troop withdrawal announcements, UN Security Council resolutions, energy corridor agreements. Each of these compresses the geopolitical risk premium in defense stocks and expands the discount in the recovery sectors. You rotate gradually, not all at once. The pattern across 100 years of data is consistent. Defense stocks lead on the way up. Recovery sectors lead on the way down. The rotation window after a ceasefire signal has historically been weeks, not months. Risk check. Read this before you act. This video is educational content, not financial advice. Every war is different. The post-Vietnam stagflation period broke almost every post-war pattern. A nuclear or cyber escalation scenario breaks them all. The reconstruction thesis requires the conflict to actually end, which is never guaranteed. See Afghanistan's 20-year timeline. Size any position according to your own risk tolerance and time horizon. In Canada, check TFSA and RSP, eligibility for any ETF before buying. In the US, check tax treatment of ETF distributions. Past performance of any sector or ETF does not guarantee future results. The crowd panics when war starts. It celebrates when war ends. Neither reaction is where the money gets made. The money gets made in the rotation, identifying which sectors are priced for permanent wartime and which are already pricing in peace before peace is confirmed. 5 plays, 1 framework. Consumer discretionary, infrastructure, real estate, financials, and long-duration bonds. Not all 5 will work in every post-war cycle, but historically, at least 3 of them have outperformed in the 12 months after a major conflict resolved. The question is whether you are positioned before the news or after it. Which of these plays are you watching right now? Drop it in the comments.